Fran, obviously you're managing an investment company in the North American sector, and you're joining us from Philadelphia. Where are you currently seeing opportunities in the US? And if you could give us some examples of companies in the sectors, even better.
Yep. Yeah, I think in the North American Income Trust, we have both a growth and a dividend mandate, and we're finding opportunities, largely across all sectors, in a high quality, best ideas type way. And I think, you can start with the healthcare side. We know that an aging demographic is going to have different needs than what we've seen in the past. And what we do is look for companies that have both growth and value characteristics. And a company like Bristol Myers, sort of checks that box for us. It's trading at 8 times earnings. It pays a healthy 3% dividend. It has a nice pipeline from a recently acquired company and very, predictable cash flows. So I think, in healthcare, we see something like that. Conversely, on the defense side, we see a company, a core holding like Lockheed Martin, that has a best-in-class, aeronautical division with the F-35 fighter that's in great demand, steady cash flows, predictable earning stream, long duration assets. And, we like a name like that over the industrial side. And then switching to the consumer side, we have a company like Home Depot, that has, home improvement story, and it's a high quality name trading at a reasonable valuation that we see, unabated demand for their services sort of in a post-COVID environment. And we got into this name, right at the onset of COVID when all the stocks were derated. And we see a company like that with great demand, great visibility, and sort of a long duration timeline as far as where we see that demand coming from. Finally, just one more, a company like Citigroup, I think, we look at the banks, and the banks were part of the problem 10 years ago. And I think this time we're part of the solution. And you see investors like Warren Buffett voting with their feet on this front. You see the bond spreads of these financials doing well. And a company like Citigroup trading at 0.75 book, we find, terrific value in that name.
Really diverse bunch of sectors and companies there, Fran. Zehrid, you manage a global investment company. I'm wondering how much you have allocated to the US and why, and where are you currently seeing opportunities in US markets?
Yes, we've got about 40% of the portfolio in US equities. That makes us about 18% underweight. So that's an important point to highlight. Where we stand out from other quality growth investors typically is we don't have any exposure to the FANGs. We find opportunities in some of the tech space, but away from those names. So we've got names like TSMC, CyberArk in the cybersecurity space, which we see as an area of accelerated growth as the economy has been shifting to online and to cloud computing. We also see a lot of great opportunities in the medical tech space. So our healthcare exposure is quite significant, but it's all coming from medical technology rather than pharmaceuticals. And in there are some great opportunities like Massimo, which is operating in the oximetry space. It's a two-player market, so very much a duopoly, highly consolidated, which means low risk of competitive pressure, good pricing power, and that feeds into attractive growth, but also good steady returns potential for these companies. Or Viva Systems, which is a cloud software company for the healthcare sector, which again is an attractive growth area in a niche segment. So there's a lot of opportunities for us, a lot of ways of harnessing the US economy actually, because underlying we are about 2% overweight the US economy by revenue and by profits, but we find those opportunities outside the US equity market.
Interesting. Now, Paul, you also manage a very well-known global company around since 1868. How much do you have allocated to the US and why? And what does that US asset allocation add to F&C's portfolio?
So we made a decision back in 2013 to adopt a much more global approach to investment, and that meant cutting domestic UK exposure from around a third of the portfolio at that time to around about 5% today. We allocated that capital globally, but naturally much of it was allocated to the US. And as it stands now, we have around about 60% of our portfolio, just under 60% of our portfolio in the US. And this covers exposure to listed equities, large cap, small cap, as well as unlisted private equity opportunities. Now, we do have a diversified approach, and we do invest into what might be regarded as growth stocks like Amazon, Alphabet, and Microsoft, but we do also have exposure to specific value strategy as well, which provides other benefits as well as income. In terms of what that US asset exposure has done for our portfolio, the US in general terms has delivered far superior revenue, margins, earnings growth, and basically added returns for shareholders. It's been the preeminent market globally for the past decade. It contains some of the fastest growing, highest quality businesses globally. And as I said, it helps us to meet our dual objective of delivering capital and income growth for underlying shareholders. And just to put a number, just in terms of the extent of US outperformance against the domestic UK market, over the last 5 years, the US is up by around 125% in absolute terms against the UK, which is up by less than 20% in total return terms over that period.
Yeah, that number is a very convincing story for the US, isn't it?